I'd like to conclude our three-lecture series on the cost of capital by talking about perhaps the most contentious issue, the cost of equity. Basically, there are three methods that one can use to calculate the cost of equity: simply adding a spread to the cost of debt, the dividend discount model, and CAPM, the capital asset pricing model. Of these three, the capital asset pricing model is by far the most popular. First of all, the simplest one, which is simply adding a spread to the cost of debt. One takes the yield to maturity on the firm's debt and just adds a spread that's necessary to attract equity investors. Typically that spread is just a few percentage points. I want to just add a caveat here. Even though adding a spread to the cost of debt is a popular way of calculating roughly the cost of equity, it's theoretically incorrect because it relies on the judgment of the analyst. One advantage to the adding a spread to the cost of debt method is that it reminds the analyst of an essential relationship among the costs of capital. The cost of equity, KE, in general, is greater than the cost of debt for the corporation, and the cost of debt is greater than the risk-free rate. If ever one sees this relationship being violated, one has to ask what's happening and come up with a very good explanation. This strict ordering of costs is clear from a simple thought experiment. Both debt and equity are claims on the same firm, but debt is a senior claim to equity. The owners of the firm would not wish to give debt investors a better risk-return deal than they give themselves. And on the other hand, if debt and equity were trading in the market for the same company, and if the debt were yielding more than the equity, then no investors in the market would ever want to buy the equity. That way the equity price would drop, and it would drop until such a time as the return on the equity exceeded the return on the debt. One possible explanation for a reversal between the cost of debt and the cost of equity could be taken from lecture 14, the perspective of the banker. Remember, in that lecture we said that the banker would break even if the probability of payment on the one-year loan times the return of the loan, that's the principal plus the interest in the loan, was equal to 1 plus the cost of funds of the banker. So the probability of payment, or 1 minus the probability of default, throws a wedge between the expected return of the investor and the cost of capital to the company. If the probability of payment were 92% and the cost of funds here with a banker was 10, then the K, the promised interest, would be 20%. That K would be the cost of debt capital to the company. If the cost of equity of the company were 15%, then you'd have a case where the cost of equity was less than the cost of debt, although the return to the investors would be only 10%, and the return to the investors of the equity would be 15%. So on the investor's side, you would not have a violation of the ordering between returns of debt and equity, but on the issuer's side, on the company's side, you would have a violation of the ordering where the cost of equity here would be less than the cost of debt. These cases, however, are very few, and in general, we do not see those conditions in publicly traded companies that are actively issuing debt and equity. So one can keep in mind the rule of thumb that the cost of equity is equal to the cost of debt to the firm plus some spread. Moving on to a more theoretically consistent view of the cost of equity, we return to our pricing formula that we got from our net present value lecture. The price of any security is simply equal to the present value of its cash flows. And remember that the security equity has cash flows coming to it expected in the future from the dividend flow paid out by the corporation. So the value of equity is simply equal to an infinite sum of expected future discounted dividend, where we discount those dividend cash flows by the cost of equity. Now clearly, if we already have the price, because we observe the price in the market, it's the share price, and if we already have an expected dividend flow, then we can calculate the cost of equity. We can express the value of the firm as the dividend in the next period growing at a constant rate discounted by the cost of equity. Rearranging terms by bringing the p to the denominator here, the k minus g to the numerator here, bringing the g around to the other side, we have the cost of equity is equal to the dividend yield, where this is the next period's dividends, the expected dividends in 1 year, divided by the current price plus the growth rate. And this is the growth rate of dividends that is expected to prevail forever. So remember that the dividends are equal to the current period dividends that we observe times 1 plus the growth rate. Now, the dividend discount model is theoretically correct. So as long as investors are rational, and as long as we can observe these items in the market, then we can calculate a reasonable cost of equity. Like most publicly traded companies, Sinopec Corporation publishes information about its past dividends, so we can look at its entire dividend history. I summarize the payout of dividends for Sinopec. 2000 is the first year for which we have dividend information, and 2014 is the last year. The dividends ranged on a per share basis from 8 fun per share up to 24 fun per share. But in 2012 there was a stock dividend. So this was a split. Holders of 10 shares were issued 3 new shares for free. So in order to calculate the dividend for growth purposes correctly, I've divided all of the dividends prior to 2012 by 1.3, the amount of the split, in order to give correct split adjusted basis for dividends. And you can see here the implied cost of capital from my dividend growth rate. So here I calculate the 3-year, 5-year, 10-year, and 14-year growth rate. Clearly, growth rates in recent years have been slower than growth rates in past years. I take the dividend yield, that would be D0 over P0, and I multiply it by the growth rate to get expected dividends in the next year, and I add to that the growth rate, giving me an implied cost of equity. So I have 4 different implied costs of equity based on 4 different growth rates. Using the adding a spread to the cost of debt method of calculating the cost of equity can give us some insight as to which of our implied costs of equity are closer to the true cost of equity. You remember the cost of equity is greater than the cost of debt, which is greater than the risk-free rate. What is the risk-free rate? Well, we're dealing, of course, in renminbi. One can get the yield curve for the renminbi, the currency of Sinopec, from the People's Bank of China, and using just December 2014, so that our numbers correspond to the numbers in Sinopec's year-end 2014 annual report, you can see we have a familiar upsloping yield curve. We want to calculate the appropriate cost of debt, the 10-year cost of debt for Sinopec, from market information and from information in Sinopec's annual report, and we're lucky that footnote number 29 in the annual report describes 2 debentures of interest that can help us calculate. One is an 180-day debenture that was issued in 2014, and the second is a convertible debenture. First, the 180-day debenture. It was issued with a yield of 4.49 in May 2014. Secondly, the convertible debenture. The yield of the convertible debenture is not useful because a convertible debenture allows the holder to convert that debenture into a specified number of shares. That conversion option serves to lower the yield on the debenture, so one cannot look at that as the cost of debt. However, Sinopec's footnote number 29 calculates, using a model, the implied spread over the riskless rate that the convertible bond impounds, and they give it to us as 1.23%. If the yield curve were flat between the 180-day rate and the 365-day rate, then that would give us an implied spread of 1.23%. We know that, in fact, the 180-day rate is probably lower than the 365-day rate, so that implied spread is probably understated. That gives us confidence that the convertible spread of 133 basis points is in fact a valid spread. So we take that 133 basis points, we add that to the 10-year riskless rate, and we get an implied cost of the long-term debt pre-tax for Sinopec. We wanted to calculate the cost of debt to find out whether, using the cost of debt plus the spread methodology, our cost of equities were reasonable. We've now calculated a cost of debt, this is pre-tax cost of debt, of 4.95%, roughly speaking, and we can compare that 4.95% cost of debt with our costs of equity implied by the dividend growth model. Our spreads over the cost of debt range from 11 basis points up to 9.5%. Clearly, 11 basis points is too low a spread. Why would debt investors shift from a relatively riskless investment into a highly risky investment for only 0.11%? Yet the 9.56% spread looks too high. Typically, we anticipate that the spread between the cost of corporate debt and the cost of equity is only a few percentage points. Here we have 9 percentage points. At this point, we could check with analysts to determine what they believe the true sustainable growth rate of Sinopec's dividends are. Clearly, 1.3% is too low, 10% is too high, giving an implied cost of equity ranging from 5% to 14.5%. We now turn to our third method for calculating the cost of equity, CAPM.